All right, here we are. This is Tim Judge for Home Search TV. I'm with my new friend Burney
Burney,
Ashley.
Burney.
Burney Ashley, that's right. Who is a longtime professional in the mortgage and real estate business over 4 decades, I think I've read correctly. Um, with streaming accolades from realtors and customers, has a solid reputation in the greater Detroit area and for funding and beyond. And he's dedicated to helping the real estate partners take their business to the next level and have programs and the resources to make it happen. Thank you for joining us today, Bernie.
Well, thanks for inviting me, Tim. I appreciate the opportunity.
My pleasure. My pleasure. So, decades in the business, what is your reaction to what's going on today versus, I guess you can go all the way back into the 80s of when things took turns south like this?
Yeah, yeah. In fact, I jumped into the real estate industry in 1980, and by 1982, the whole thing was turned upside down. So I'm used to this stuff. Back then, the problem was stagflation, where
Right.
rates were double digit, and nobody could afford them. Well, we're kind of pushing to that direction again. Not that rates are outrageous. In fact, rates are beautiful.
Right.
They're taking us way back to the 60s and 70s as far as rates. But problem is, lenders are in a tailspin. The federal government didn't really think that out when they decided that people shouldn't have to make their mortgage payments anymore, which would have been fine and dandy if they would have included us in the loop. They're bailing out the unemployed, they're bailing out small businesses, they're bailing everybody out, but they dropped this bomb on us and just left us to sort it out. So,
Right.
uh, like I say, it's really crazy. And so the opportunities have gone away. Hopefully, things will settle down and we'll get back. But today, if you show up for a mortgage, you better be pretty well qualified. You're not going to slip through the cracks anymore. In fact, if you're looking for a jumbo high balance loan or something out of the box like a non QM, you're going to find yourself out of luck. Or if you find somebody that'll do it, it's going to cost that rate ain't going to be appealing at all.
Right.
So,
So
so yeah,
the couple things I'd like to point out: a non-QM is a non-qualified mortgage, so someone who doesn't have 20% down or 700 credit score, or what makes it a non-QM?
well, generally, one of the biggest ones that I'm working with is the bank statement loan. These are for self-employed people that we can't really track their incomes well on their federal 1040s. So
Right.
we go past that and look into their actual bank account to see if do they have liquidity in that bank. If you tell me you're making $10,000 a month and you can show me $10,000 a month running through your bank every month, then I assume that you're not lying to me. So
Right.
it's just another, as far as the crazy stuff we were doing before 2008, that'll never come back. Nobody's going to go out there on a limb and just sign you up with no credentials. The feds did work they snuck in a little the ability to pay. So that kind of keeps everybody in line, even non-QM lenders, because at the end of the day, if a borrower can prove that the lender made them a loan and there was no good reason for that loan, the qualifications weren't there, they can actually sue that lender, in which case the lender would actually have to send them every dime that they ever sent us, along with a release of mortgage. So it's a free house, and lenders don't want to give away free houses. So they still have to total line. You have to have some kind of credentials to prove that you did deserve the loan. So like I say, that stuff back in the 2000s, that's gone forever.
Right. They also put some handcuffs on the appraisers back then too, so that
Yeah,
they couldn't get outside help in appraising anything, and they were on the hook as well. So
yeah,
everything got tightened up back in 2008.
Sure.
And this is definitely not caused by, this is the invisible danger that took over this market right now,
Yeah.
that put
Right.
everybody out of work for the last 30 days.
Yeah. Hopefully, this one, if we can settle, if the economy can settle down, if we can get back to work, I don't think, I think this will be temporarily. If it goes on for months, I don't know, then we might find ourselves back in that, not 2008, but that 1982 problem. The Fed's running out there spending trillions and trillions. When the Fed borrows at those rates, that's how we got to the stagflation of 82. When the government carries big debt, it causes inflation. So if you got inflation, along with, like I say, it's not double digit rates that kept people from buying then, but if you're just ruled out, well, they say, well, you're not qualified enough to buy, then you have those two problems showing up at the same time. And I could see us going back in that direction.
Right.
Where people can't buy, houses start building up. I mean, back in 82, you drive down the street and 8 out of 10 houses had a sign on them and none of them were moving. So,
Right.
but this one, I think, like I say, if we can get this done and get back to work, I think it's going to be a bump in the road and we'll be okay. But right now, we
Right.
have some very serious things going on, especially for servicing.
Yeah, I know that the servicers and the underwriters are overwhelmed because the rates are so, they had been so great that everyone was refinancing and trying to take advantage of this. So they're backed up. There's a backlog in getting that done. And now with new home purchases at a crawl, if that can
Right.
happen even, when we do get the go, I know I talk to a lot of real estate agents that are, drumming to get out there and make some
Right.
deals. Of course, missing out on the spring market is pretty painful to everyone, but coming out of the gate strong, trying to get deals done is going to be very difficult, even if they can make it happen. If
Yeah.
they get the customers out there, I mean, there's going to be people that want to move, but the mechanics of getting the loans funded and approved, like you say, is going to be the biggest challenge it's not finding the buyers and sellers because everybody's sitting at home looking online for what they want, waiting for the moment to pounce. So it's going to be a little tricky, but mortgages are going to be the biggest hurdle of that program, I think, don't you?
Yeah, we're going to your first time home buyers, that's the first ones I see in trouble.
Right.
Most of them, aren't put together well. And this thing where you come in with a nickel and a 580 credit score and buy a house, that's absolutely not happening right now.
Right.
Uh, things settle down, maybe we can get back to there, but we're eliminating a whole lot of buyers out there. So um, what I can see is, spring, like I say, generally everybody be listing their homes. Well, eventually when they open up the door, signs are going to go up and down the street.
Right.
But the buyers, a lot of those people are going to be on the sidelines until the lenders can pull their liquidity back. Which, with in these forbearances, it ain't like they're going to go away. Even if they said, okay, everybody go to work tomorrow, that's not going to help the lenders
Right.
because, in fact, we just got a break today. It was like breaking news or late yesterday. Mark Cabell from the FH, what was FHFA, who kind of controls the whole servicing thing. Well, they put the forbearance out there where there's like 3 million. The numbers are outrageous. I mean,
Right.
you're talking about Ginnie Mae's. We got 8.26% of the mortgagers in default right now. Fannie and Freddie are running 4.64. These people ain't paying their payments. Well, guess what? Lenders don't get off the hook. So we got investors that we sold these loans to, and if we're servicing them, they get paid. Taxes have to be paid. Insurance has to be paid. PMI, whatever's going on with that loan, that has to continue to go. Well, these lenders were not sitting around on a big pile of cash expecting something this crazy to happen. Where all of a sudden, 5% of the borrowers out there just going to not going to make payments. So they've limited it to 4 months, and apparently that was not a big deal because I didn't see anything going on my side. I'm looking at rates, I'm looking at the bond market, and so no great rally. So I guess that wasn't too exciting. It's still a lot of cash, but at least we got an end game now. Before it was like we didn't know, how long are we going to have to, sometimes it could take you a year or more to get a house back. So if we had to fund that thing all that time, that's where it gets serious. So
Right.
that's really the reason that, and then the other problem is low rates. People don't understand this, but when I sell an investor a loan, they expect that loan to be around long enough. In fact, on average, it takes them about 3 years just to pay me and servicing and so forth and so on. Takes about 3 years just to get that money back. So when these rates crash, and we just had a refi boom, last year, and now all of a sudden these same people are coming back for the second wave of refinance. Those investors get burned. That's the loan that they were expecting to break even. Well, they're not breaking even if you're coming back 6 months later. They paid commissions and so forth, and now they got squat. So like I say, they're just really, really in the vice right now, and that's the reason for all that's the reason for all the overlays. Like I say, every product I have is different. No matter what you qualified for last month,
Right.
Those rules are in the garbage. They're gone, and we got brand new rules. So, like I say, right now you got to be a pretty good customer to get a loan. So when we get back and we got all these houses on the market, and I don't know how many. I know the first-time homebuyers is our biggest market, so those guys, I don't see those guys coming in that strong. Where they're going to come in with 680, 700 scores and 20% down and all that stuff. I don't see that happening. So there's going to be a divide there.
It's going to be very frustrating for realtors and mortgage people trying to make these deals work.
A lot of the realtors I'm talking to, I get the impression they think they're just going to, one day, they're just going to go back to work, fire the place up, and everything is going to be the way they, just turn the lights back on and we're back at it, right? No, that's not going to happen. It's going to be, we're going to have to crawl before we walk, and we're going to be back in the crawling stage.
Right. And then a lot of the mainstream news is talking about the Fed rate and how that's lowered and how, they're easing credit standards and everything, but that's not tied to the home purchaser, right?
Well, the Fed rate helps out the federal banks. So banks out there like Chase and Citi, Bank of America, those guys, what that enables them to do is keep more loans on the books. They came up with a standard after the Great Recession so we didn't have that run on the bank thing going on.
Right.
Everybody runs into the bank to get their money, and then they find out, oh, that's Joe's mortgage and Mary's mortgage. We don't actually have the money in the safe, and it goes insane. So they said, well, you got to keep so much money in the vault just in case Joe and Mary want their money. We can't be sitting there empty-handed. So what the Fed rate does is, once you get to that point, the bank still wants to make a loan, but they're already cashed out. They can go to the Fed and borrow that money for 0%. So that's a big break on their side. They're going to borrow it for 3% and then sell it to you for 3.25%, 3.5%.
Right.
It's a pretty good deal on their side. So it seems like it ain't helping much because those are the guys with the most fierce rules. I mean, Chase come out with that mind-blowing, hurdle that they put out there. 700 score, 20% down.
Right.
And they can get the money for free. So maybe they just got too many loans too. That's another thing. Once you can only run so many loans to through the pipe anyway. Um, they've they've come to the conclusion that if we actually mortgaged everybody that could be mortgaged on a refinance, I forgot how many trillions of dollars it would be, but all the lenders and all the United States added up wouldn't be able to do it in a year's time.
Right.
So there's a divide there, which makes lenders say, well, if we can't do them all, let's just hold out for the good ones.
Right. Well, that's the thing. I mean, when before this came down, we had very low inventory and pretty good rates.
Right.
And we were still, there was a bit of refis, and of course, every time it ticks down a point, the refis come back out of the woodwork. But
Right.
after the last 8 years, if you still own your home and have your place, you've refied, so you don't have to move unless you have to move, and those people are going to stay where they are. So the inventory is not going to come screaming back. So they want to slow down the pace of people trying to get mortgages and move on, because one, credit's tough to judge when, if you've been out of work because of corona, or now your job and everything has changed. So this is all going to have to be double checked, and now the lenders are going to be under the gun to prove everything. So that's why they want to make these restrictions or criteria a little more restrictive, so that they don't get into making bad loans, and they want to slow the process down, because everybody's going to come running out of the gate saying, take my money, I want to make a move. But it's going to be difficult for the mortgage industry to make all those deals happen, right?
Yeah, in fact, one of their biggest nightmares is the guy that shows up today is totally qualified, is totally working. But as you know, we close a deal and there's really a payment doesn't come along for a couple of months. So there's that big gap between there where his boss could hand him a pink slip, and now he can't make his mortgage payment, or he gets sick with the COVID, or a direct family member gets sick, and now he's not able to. So he comes and applies for that forbearance
Right.
before that first payment is made. Well, that's the kiss of death in lending.
Yeah.
The first payment default, totally. What happens is we get that loan right back. Okay, it's right in the contract that guy has to make the first payment. So that comes back to the lender. They now own the thing, and you can't sell that anywhere in the world for at least a year. Then you're going to take a 4 or 5 point hit on it if you can sell it at all. So this is another big cloud over them, And unfortunately, the government standards on this one are much lighter than they were in 2008. I mean, if you remember that mod thing, God, I don't know how many people were applying for these things,
Right.
and half of them never even got a loan. They ended up being thrown out of their houses. They're like, well, yeah, but I signed up for the modification one. This one, the way I'm understanding it, I'm not there taking those applications. I'm not in the servicing department, but the way I understand it, it's fairly easy. You could actually even be working and somehow or another qualify for a forbearance. So, there's a lot of people out there that this will game the system.
Right.
They think, well, hey, why should I might as well just go ahead and take this, and it's not. Unfortunately, it's not that simple, because you still owe the money. 3-4 months later, you get those 3 payments that you got, you're going to have to cough up. Now, you might cough them up in payments like with us. I think they're breaking them down to you get 3 months, and then a year. They'll take those 3 months and they'll spread it out over a year. And now you're going to have a higher mortgage payment. So hopefully, you're not right at the limit when you start. That could end up being a mess. So the other thing people don't understand about this that they need to know is they tell you that it won't affect your score, and that's true.
Yeah.
But you are being earmarked.
Right.
On your credit report, there's going to be a code that tells that you weren't in the forbearance. You might have been late before you went into forbearance, or you weren't late before you. But every underwriter in the world, you come in come and see me for a mortgage. I pull the credit report. We know you've
Right.
been a bad boy. So at the end of the day, it's not going to be that simple where you just walk off, scot free. And that's the impression a lot of people are getting. They're just making it too simple. Um, and people are making these assumptions. Hey, what the heck? Let me just get in on this action. Might as well.
Right.
What's there to lose? Well, there's a lot to lose. At the end of the day, you probably ain't gonna. There's probably gonna be at least 2 or 3 years before anybody will talk to you about a mortgage after that. And so that's what people need to know. Don't make your mortgage payment if you got the money. Don't game the system. It's going to come back and bite you in the butt. And on top of that, you're destroying the housing industry by doing it.
Right. Well, in 4 or 5 months, if it doesn't shake out well with the servicers being upset about people just saying, tack it on to the end and whatever it is, and and they start this process, it's just going to make everything look more ugly than it really has to be.
Right. Yeah.
And when people should have been calling them first, saying, what can I do to, cut this in half now, spread it over a year or what? I mean, call
Right.
first. Call first and see what kind of plan you can get, rather than just sit and wait and then say, oh, but everybody was doing it, and I need some for myself.
We have several options. Like I say, Fairway Capital Mortgage Funding is, we're a branch of Fairway Independent Mortgage. And so there are several different ways. They'll work with you any which way to make it. The last thing we want is a foreclosure. And the second last thing we want is a forbearance. So, if we can work out some payment program so that, you can take care of this thing over a year's time or whatever,
Right.
that's going to be the best way, because then instead of having, that earmark on your credit report that's, going to follow you around, nobody will really know. They don't want you to be in that position. But so I know from 2008, I can't remember how many people I sat down with that did foreclose and told me straight face they didn't have to. They're just like, well, I could afford the payment, but I just wasn't going to make it because, my
Right.
house value went down. On paper, it just didn't add up. So I made a business decision and walked. And then they rented for 3 or 4 years and came back in the market and bought a house. But, that was just them gaming the system and created more messes than necessary. And, took
Right.
the housing industry out for about 5 years. That's a good 5 years of,
Right.
mess. I remember it was about 2013 when we finally kicked back in, things started moving. But those 5 years were slow and deliberate. So if people get carried away on this one, they could push us back into that. If everybody cooperates, does their best, then maybe these guys will come back and there'll be a month or two where we're slowing down, and all of a sudden, boom, we're right back in the driver's seat. And that's what I'd like to see for the housing industry.
Yeah. Well, I think we're going to take a hit. I don't think it's going to be nearly as bad as 2008 for that, because a lot of people were solid in a decent rate and a decent loan, something they could handle. So if they just call their servicer and work it out, I think we won't have a problem there. And then most of the people coming into the market now, I think it's over 40, almost 50% are first time buyers. They're going to have to look really good on paper, but when they're there, they'll be able to, because it was low inventory, they'll be able to get in the game and make it happen. But it's going to be a longer process than your average spring market, that's for sure. But if they
tweak up their score a bit, that'd be more of that kind of stuff. But that's the way it was, especially right after the Dodd-Frank come out. I
right,
remember there was just overlays everywhere, overlays on overlays. It got so bad because the lenders were also in a tailspin there where they wasn't quite sure what that what those rules equated to. So nobody wanted to take a step forward. So they just like I say, overlay after overlay after overlay, and then after a few years of getting used to working with the CFPB and knowing what's going to fly and what's not, they started winding it down to where, like I say, just before this COVID, I mean, we're in pretty good shape. Guy walks in to my office with a 580 score, and maybe 3% in his pocket, and we're off and running. So be nice to get back to that because, like
Yeah.
I say, that provides a lot of buyers. Of course, on the other hand, we actually had more buyers than we needed. We were in the seller's market, so that who knows, maybe that'll even out the playing field a bit. So you don't have to make 10 offers to buy a house. You just make one, right?
Right. So what do you suggest for those first time buyers? How soon should they get in touch with you to straighten things out? How early do they have to start the process when I know that they've all got their house picked out or they're waiting for things to hit the market when the floodgates open? How, usually, obviously I've been in real estate for a long time myself, and the first thing you do is get pre-approved and now pre-qualified.
Right.
So how early does someone have to start that process? What do you suggest on that?
Well, if you are not one of those people I just talked about, like if you're not at least a deal, well, we're doing purchases conventional at 620. We're still, as far as purchases go, my company is still flying with the old rules. It's basically um, 3 to 5% down, 620 score, and 45 debt ratio. So those rules haven't changed so far for purchases only. That only flies on purchases. So if you're one of those guys and you can fly for the conventional deal, then you can hold off a little bit. If you're not, if you're struggling a little bit with a credit score or whatever, I'd suggest you get on the phone now because, we might have to pay down some credit cards or do a little this and that. And it might take a month or two to get you where you need to be to actually run out and buy that house. So if you want to run out and buy the house, call me now.
Right. So from my experience, it was usually 60 days, 60 plus days to close on a house. So you're saying to give yourself 90 days? It's going to take a little
No,
longer
no,
than that?
no. I'm saying that we might actually, we've been doing them in on average 30 days.
Oh, good.
So yeah, you're talking a big bank like Chase. Yeah, you'll spend 2 or 3 months hanging around there, but we're more efficient than the bank. So
Okay.
we've been doing it, like I say, average of about 30 days, sometimes a little sooner, sometimes a little longer, depending on what loan and what needs to be done. But what I'm saying is now with the qualifications,
Right.
you need to show up 30 to 60 days before you even make an offer because you can't
Right.
make an offer if you're not pre-approved. And it might take me a couple months to get you where you need to be just to get the pre-approval in the first place.
Right. So then what I'm saying is that if I'm the standard realtor and you're the mortgage guy, I before I take someone into a house where we're all masked up and who wants to make the final, before he makes his
Right.
offer, we got to make sure he's with you and that all the I's are dotted and the T's are crossed and the money's there because when you're going to let somebody into the house, because nobody wants anybody. I mean, I don't know how open houses are going to run anymore, but people don't want crowds of people running through their house. They want to make sure they're pre-approved or
Right.
pre-qualified, good to go and have a strong offer coming at them before they let anybody in the house because nowadays everything is different. So you're saying that you're going to need a month or two to get somebody to the point where they want to go out and make that
Right.
final.
Unless you know for sure you're a strong,
Right.
credit wise. If you know you're a strong person, you got a great job, got great credit score, then you can come and see me a week before. But if you're somebody that if you even think you might be challenged, you'll want to come and see me because
Right.
if I can always look you over and say, hey, you know what? You don't have the problems you thought you have.
Right.
You know, but that ain't going to hurt because that credit report's good for 4 months. So, we're still good to go. On the other hand, if you show up a week before and then we find out, well, you got this, that, and the next thing, guess what? You're not going to be out there buying the house. As far as open houses go, I wouldn't expect to see those things around for at least another 6 months. I mean, that would be insane to open your house to just multitudes of
No.
people running through it at this point because COVID ain't going away next month or the month after. I mean, it might slow down.
Right.
It's not leaving. So we're going to have to be careful
Right.
moving forward. And with me, fortunately, oh man, I've been digital for about 5 years. So generally, the only time I've seen my buyers is when we get to closing. That's the first time I do a face-to-face. But so we can actually do the whole process. That's not even necessary. My buyers that are closing now, they won't even let me in. So the whole process can be done. You don't have to leave your home. If you're afraid to leave your home, doesn't matter. Give me a call. We can do this thing all on the phone, online, or just have a conversation like me and Tim are having right here. So,
Exactly.
yeah, don't sweat it that, oh my God, I'm going to have to go down to the mortgage. We don't even want you down in our building.
Yeah.
We're trying to keep people out of there so we can stay safe.
Right. Right. And then everything with the digital signatures and everything else can be done. All that
Right.
paperwork can be handled
Right.
electronically now. And I'm
Exactly.
sure that's going to become even more and more efficient.
Right. So, like I say, fortunately, as soon as
But
I heard about it 5 years ago, I was like, yeah, digital, that's where I want to be at. So,
but if
so,
COVID has taught us anything, it's to be prepared, because
right,
everybody got caught with beyond the toilet paper, no masks and not ready, and everybody worried and not knowing. So the best thing to do to be prepared, if you want to jump into the real estate market now, is to get with your lender as soon as possible. Even
right,
if you're in the best condition or a challenging position, you want to
yeah,
get that sorted out sooner rather than later. Like you said, it'll last 4 months for that. So you want to be ready to go, but being prepared is really the best step you can take right now to get your mortgage and everything finances straightened away before you pull the trigger to go into somebody else's house.
well, that's what I'd do. If it was me.
Yeah.
Again, paperwork's good for credit report, for instance. It's got a 4-month ticker on it, so um, it ain't gonna hurt. It ain't like you're doing something that's got to be redone. Uh, and that way, if something is there to prevent you from moving forward, we can, start working on it. If you wait to the last minute and show up and there's any issues, then you're just going to end up waiting some more.
Right. Right. Well, very good. Well, Bernie, it was a pleasure talking with you. I really appreciate your help and giving us the guidance on what's going to happen as soon as we do open up. I think it'll be a rush that'll be unprecedented, but I
Yeah.
think everybody's going to be nervous. So being prepared is the key. I put your email address up there. Is there any other contact information people might want to reach out to you?
Well, you can hit me on my direct line, which is 586-484-5058.
Wonderful. And then right there, lowrateonline.com. That's you?
That's me.
Excellent. Well, thanks for coming on with us, and I really appreciate it. And best of luck in these trying times in the next few months. It's going to be a really interesting ride.
Yes, sir.
Very good. All right. Thanks again. I'm Tim Judge for Home Search TV. Thanks for watching, and click back soon.
Thanks, Tim.
You got it. My pleasure.